Hey, my name is Nunu. Welcome to my video. So let's start. It is a Tuesday night and you are looking at your phone. You just opened your banking app, not because you need to buy something, but because checking your balance has become a low-grade anxiety that never really goes away. You have a decent salary, your 401k is active, and you pay off your credit card every month. On paper, you are doing everything right. Yet the number on the screen looks almost exactly the same as it did 3 months ago. Your financial life feels like a lake that is being filled from one end and drained from the other at the exact same rate. You feel poor because, despite your hard work, your money is spoken for before it even hits your account. This feeling is not a sign of failure, but a sign that you are following a conventional financial script that was not designed to make you wealthy. To understand why you feel this way, we need to look at two different paths. Consider a person named Sarah who follows the standard advice. She bought a home because she was told renting is throwing money away. She drives a reliable new SUV with a standard monthly payment, and she saves exactly 10% of her income. On the outside, Sarah looks successful. She has the house, the car, and the travel reward points. Then there is Mark, who earns the same salary, but lives unconventionally. He rents an apartment, drives an older car he bought with cash, and saves 35% of his income. Right now, Mark's life looks smaller, but the math tells a different story. Over 30 years, the gap between these two lifestyles is approximately $2.2 million. Sarah will likely work until she is 66, while Mark could stop at 51. You feel poor because you are likely living Sarah's life, where your wealth is visible to others but invisible in your bank account. The first reason for this feeling is the 10% savings trap. Every financial article and well-meaning relative tells you that saving 10% is the mark of a responsible adult. However, in 2026, the math of 10% is mathematically insufficient for most people. If you earn the median U.S. household income of $83,000 and save 10% for 30 years, you might end up with $1.3 million. While that sounds like a lot, the standard withdrawal rule means it only provides about $41,000 a year in income. Since the average household spends $77,000 a year, you are facing a massive annual shortfall. Saving 10% is like trying to lose weight by drinking 2.5 sodas a day instead of 3. It is progress, but it is not enough to change your reality. It takes 51 years for a 10% saver to reach financial independence, which means most people are essentially saving to be broke at age 70. The second weight on your shoulders is the subscription to permanent debt, specifically through car payments. The average new car payment has climbed to $767 a month. This is no longer just for luxury vehicles. It is the price of a regular car for a regular person. Dealerships have shifted the conversation away from the price of the car and toward what monthly payment you can afford. This is a psychological trick designed to make you stop thinking about the total cost. A $45,000 car loses 20% of its value the moment you drive it off the lot. By year 5, many people are upside down, meaning they owe more than the car is worth. When you trade that car in and roll the negative equity into a new loan, you aren't just buying transportation. You are subscribing to a cycle of wealth destruction. If you invested that $700 a month into an index fund instead, it could grow to over $1.5 million over 30 years. You feel poor because you are driving your future millions today, and those millions lose value every time you turn the key. Then there is the heavy burden of homeownership in the modern economy. We are culturally conditioned to believe that buying a home is the ultimate financial goal. But in 2026, across the largest U.S. metros, buying a home can cost 57% to 131% more per month than renting a similar property. When you buy a $450,000 home with a 6.5% interest rate, you are not just building equity. You are signing a contract to pay $458,000 in interest alone over 30 years. In the first few years of your mortgage, almost all your money goes to the bank, not to your equity. On top of that, you are responsible for property taxes, insurance, and maintenance that cost 1% to 2% of the home's value every year. This creates a massive cash outflow that rarely shows up on a standard mortgage statement. This creates what experts call a 30-year wealth tax. When housing costs consume 40% or more of your gross income, it structurally prevents you from building wealth anywhere else. You cannot max out your 401k, you cannot build an emergency fund, and you cannot take risks in your career because you are tethered to that monthly payment. This financial strain has a real biological cost. Research shows that heavy financial stress can reduce your cognitive performance by the equivalent of 13 IQ points. You feel poor because the American dream has become a financial straitjacket that limits your flexibility and your brain power. Another invisible drain is the cost of professional management and the friction of modern spending. Many people hire financial advisors who charge a seemingly small 1% fee. But over a 30-year career, that 1% fee can consume nearly $934,000 in potential compounding. You are often paying a premium for a product that has a 94% chance of performing worse than a simple, low-cost index fund. At the same time, the way you pay for daily items is working against you. Credit card companies spend billions on research to remove the pain of paying. When you use a card, you likely spend 12% to 18% more than you would if you used cash. You might get 1.5% in cash back, but you have increased your total spending by 15% to get it. You aren't hacking the system is hacking you to make you a more efficient consumer. The reason we continue to follow this path is due to our biology and social pressure. Neuroscientists have found that going against social norms activates the same parts of the brain as physical pain. When everyone you know is buying a house or a new SUV, your brain physically pushes you to do the same to avoid social discomfort. Furthermore, we suffer from a visibility problem. You can see your neighbor's new kitchen renovation, but you cannot see their credit card debt. You can see the luxury car in the driveway, but you cannot see the empty brokerage account. We are constantly competing with the visible consumption of others while ignoring the invisible destruction of their wealth. To stop feeling poor, you have to understand where you are in the levels of savings. At the 0 level, money is an emotion, usually fear. A $400 car repair is a crisis because every dollar is already spoken for. When you finally save your first $1,000, it is not about the money itself. It is proof that you can hold capital. This is the start of an identity shift. You move from being someone who manages cash flow to someone who builds wealth. As your savings grow to $31,000, your relationship with money changes again. Money stops being an emergency and starts being a tool. You gain the power to negotiate your salary or walk away from a job that doesn't respect your time. Your money starts to generate its own income, perhaps $1,000 or $400 a year, which is money earned by your capital rather than your body. By the time you reach $210,000, the machine has its own momentum. You might see $14,000 in returns in a single year without working an extra hour. You stop thinking about saving and start thinking about deploying capital. When you reach the higher levels, like $740,000 or $1.4 million, financial freedom stops being a fantasy and becomes a timeline. At $1.4 million, the portfolio can generate $70,000 a year, meaning your labor is entirely optional. It took years of discipline to get there, but the urgency and the drama of money are finally gone. The most surprising part of reaching this level is the silence. The anxiety that drove you for decades disappears, leaving you with the much harder question of what you actually want to do with your time. You feel poor because the modern world is designed to keep you in a state of financial urgency. It wants you to stay in the cycle of high consumption and high debt, because that is how banks, dealers, and advisors profit. The unconventional path, driving the older car, renting strategically, and investing heavily, looks like deprivation from the outside. But in reality, it is the only path that leads to true quiet and security. The conventional playbook was written for an economy that no longer exists. It was a world where homes cost 3 times your income and a 10% savings rate actually funded a retirement. Today, following that old advice is the real gamble. The person with the paid-off car and the simple index funds is not taking a risk. The person with the stretched mortgage and the 4% savings rate is the one taking the risk. Building wealth is not about deprivation. It is about deciding that your future time is more valuable than your current status. It is about moving from a life where money is a constant source of dread to a life where it is a quiet machine running in the background. You feel poor because you are currently working for your money, but the goal is to reach the point where your money works for you. The gap between feeling poor and feeling free is not just a matter of income, it is a matter of structure. It starts with noticing the traps, running the real math, and being willing to look weird to your neighbors for a decade or two. The account balance does not care about social norms. It only cares about compounding. Every time you choose your future freedom over a visible symbol of success, you are reclaiming a piece of your life. In the end, there are only 2 ways to live. You can follow the visible script that everyone else is following and likely end up with the same anxiety you feel tonight. Or you can choose the invisible path of building capital, where the rewards are not seen on your driveway, but in the freedom of your Tuesday nights. The machine you build today is the only thing that can buy back your time tomorrow. The math is clear, the levels are defined, and the choice to stop following a broken script is yours.